Most people who talk about de-dollarization are talking about the dollar. I want to talk to you about your brand because here's what no one in your communications team is telling you. The shift away from dollar dominance is not a currency story. It's a trust architecture story. And if your enterprise operates across borders, or if you raise capital from international investors, if you process payments across jurisdictions, if you sell into markets outside your home territory, this shift is already affecting how the world perceives your market position. Not next year, right now. In this briefing, I'm going to do three things. First, I'm going to tell you precisely what de-dollarization actually is and strip away the noise. Second, I'm going to show you the specific mechanisms by which it reshapes brand trust and market positioning. And third, I'm going to give you a concrete diagnostic, the questions your leadership team should be asking this quarter if you want to stay ahead of the shift rather than react to it. Let me start with what de-dollarization is not. It's not the imminent collapse of the US dollar. It's not the end of dollar-dominated trade overnight. And anyone telling you those things is selling you something. It's probably not a product you need. Here is what it actually is. De-dollarization is the systemic, coordinated effort by a growing number of nations and institutions to make the dollar one among several rather than the only option for global trade and settlement. The bloc's strategy is pragmatic, not revolutionary. Build enough parallel infrastructure so that the dollar becomes one settlement among several rather than the only viable choice. Now that framing matters enormously because the threat to your brand's market position is not a sudden dollar collapse. It's a slow structural rebalancing of where institutional trust flows, and the entity's position on the right side of that rebalancing will compound enormous advantage over the next decade. The data here is real and recent. China's cross-border interbank payment system processed the equivalent of 245 trillion in yuan-dominated transactions in 2025. The BRICS bloc now represents 47.9% of the global population and has settled 85 to 90% of intra-bloc trade in local currencies. The BRICS unit, a gold-backed settlement instrument piloted in late 2025, is now in active deployment. And critically, the US dollar index logged its steepest 6-month decline in more than 50 years in the first half of 2025. A drop that analysts at Deutsche Bank described not as cyclical market volatility, but as, quote, dollar confidence crisis, end quote. When the dollar's largest reserve currency experiences a confidence crisis, the narrative infrastructure that was built around it begins to fracture. And your brand sits inside that infrastructure, whether you know it or not. Now, here's the mechanism, and this is part of why your traditional PR team cannot explain to you because they do not operate at this analytical level. Dollar dominance has never been purely economic. It was always narrative as well. The dollar worked not just because it was the most liquid currency in global markets, but because it carried a story. Follow me. A story about American institutional reliability, legal infrastructure, and the credibility of US-backed financial rails. That story told every institutional investor, every cross-border buyer, every sovereign entity what kind of counterparty you were. If your company operated in dollar-denominated systems, issued dollar-denominated reports, and accessed dollar-denominated capital, you inherited a layer of legitimacy not because of what you built, but because of the system you operated inside. When that system's credibility erodes and the data I've just cited tells you it is eroding, the legitimacy transfer stops. Which means the question every enterprise with cross-border exposure now faces is this: what is your narrative architecture independent of the dollar's credibility infrastructure? Let me make this concrete with a scenario. If you're a fintech company operating across 3 jurisdictions, let's say the UAE, Singapore, and London, you have been raising capital from a mix of US and Gulf institutional investors. Your pitch deck is denominated in dollars. Your compliance reporting follows dollar-era frameworks. And your public narrative is built around metrics that institutional dollar world investors recognized. Now, your Gulf institutional investors are increasingly selling trade in dirham yuan bilateral agreements. They're deploying capital through BRICS, NDB, local currency loan structures, and they are asking their portfolio companies about exposure to dollar denominated volatility. Your narrative has not kept pace with their reality. That gap is a commercial liability. It is not a crisis yet, but it is what I call narrative drift. And left unmanaged, will cost you either the relationship, the valuation, or the next round. This is what I mean when I say de-dollarization is a brand positioning problem before it is a financial problem. The institutions moving fast in a multipolar world are the ones who already have rebuilt their narrative architecture to operate across trust systems, not just dollar trust. They have not waited for their investors to ask the question. They have answered it preemptively. What does this actually look like operationally? I see three distinct exposure types, and I want to walk you through each one briefly because they require different responses. Exposure one, investor narrative misalignment. This is the most common and the most immediately costly. Your capital base is shifting. Gulf sovereign wealth funds, Asian institutional funds, and emerging market family offices are all rebalancing their portfolios away from exclusive dollar exposure. If your investor narrative still speaks only the language of dollar world valuation metrics, you are speaking to a shrinking subset of your actual capital pool. The fix here is not translation, it is architectural. Your narrative needs to credibly address how your enterprise performs across currency and regulatory environments, and not just inside one. Exposure two, compliance narrative fragmentation. Particularly acute for fintech and regtech operators who have built your compliance architecture to satisfy FCA, SEC, or CFTC standards. Those are dollar world regulatory frameworks. As your clients and partners increasingly operate in DIFC, MAS, and NDB adjacent environments, the compliance story that protects you in one jurisdiction may not actively create suspicion or may create a suspicion in another. I see this most often in companies entertaining or entering Gulf or Southeast Asian markets who cannot explain their regulatory standing in terms that resonate with non-dollar oversight bodies. Exposure three, algorithm narrative drift. This one is the most underestimated because as institutional investors increasingly use AI due diligence tools to pre-assess counterparties, the way large language models synthesize your corporate presence matters enormously. If your public narrative is built entirely around dollar-denominated metrics, Western legacy media coverage, and U.S. regulatory language, you systematically underperform in the LLM-generated assessments used by Gulf, Asian, and Latin American institutional investors. You are invincible to a growing share of the most capital-rich buyers in the global market. None of these are existential risks today. All three become existential risks in a 5-year horizon if you do not act in an 18-month window. That window is open now. I want to leave you with a diagnostic. 3 questions to bring to your leadership team this week. Not to create alarm, to create clarity. Question 1. If your top 3 institutional investors over-index to Gulf or Asian capital tomorrow, would your current investor narrative resonate with their risk and valuation frameworks, or would it require a complete rebuild? Question 2. Does your communications team have a cross-border narrative that operates independently of dollar world legitimacy signals, or is your credibility entirely barred from the system that is under pressure currently? And question 3. Has anyone on your team audited how AI due diligence tools currently summarize your company to a non-Western institutional buyer? If the answer is no, that audit is overdue. If you answered no to any of those 3 questions, or if you found yourself uncertain, that certainly is the signal. It is not a problem your PR agency can solve. It is a narrative infrastructure problem, and it requires a different kind of intervention.